Want to get started trading options? Unsure where to even begin? Well, here's a great beginner guide to learn the basics. You think they're risky? Think again. Watch this video for more. Hello again, welcome back to Mind Money Masters. I'm Cameron, and today we're going to start a discussion on stock options. One of my favorite trading vehicles of all time. Before we get started, please make sure to subscribe to my channel, turn on notifications, that little bell up there, as you can see any of my new videos. Also, please check out the description in my video. I've provided several other links and videos that show you how you can learn different trading strategies and also build some passive income. Please remember, my opinion in this video are simply my own, and this video does not offer any financial advice or investing advice, as I am not a licensed advisor. Please work with your professional advisor before making any investment decisions. You know, I found this quote by George Soros very interesting, and I wanted to share. The financial markets, generally, are unpredictable. So that one has to have different scenarios. The idea that you can actually predict what's going to happen contradicts my way of looking at the market. You know, it's interesting because that last statement really caught me, because I believe the exact same thing. There is no way to predict the market, but with certain strategies, you may be able to control your risk and in some cases eliminate it completely. This is why I love trading options, and also because there's so many different things that you can do with them, and why I want to share what is popular and what can be done with them. Let's get started. So what are stock options? This is, you know, the basics of basics. And you know, first, I really wanted to talk about, you know, the beginner's guide. This is something that's super important to understand the basics. We are starting from ground zero. So I have multiple videos on options, so there will be more detail in trading strategies and advanced strategies in those. I will tell you that there is a big difference, first of all, between stock options in trading and stock options that you receive or may receive from your employer. We will go over the employer options on a later video, but today I'm specifically talking about stock option contracts in the stock marketplace. These contracts allow the buyer or holder to buy or sell shares of a stock at a specific price within a certain period of time. More on this later. Trading stock options is a practice that allows investors to leverage their assets, and many people are aware of this adage, a maxim, buy low and sell high. But with stock options, it is possible to make a profit whichever direction the market is heading. Stock options can be a great way to manage risk. I mentioned that a little bit earlier. But you know, trading stock options requires an expectation that the underlying stock may go up or may go down. If you believe the value of a stock is going to increase, you have two options. You can buy the stock outright, or you can buy a call option, which gives you the right to buy the stock at a specified price, also known as the strike price. We'll talk about that on the next slide. Before the expiration date. I'll give some definition of terms too. If you believe that the value of the stock is going to decrease, you have two options as well. You can sell the stock outright if you own it. You can short it if you don't own it. Or you can buy a put option, which gives you the authority to sell the stock at that specified price, the strike price again, before the expiration date. So we're not going to go into any strategies per se. I do talk a little bit about that on the next slide, but we will talk about strategies on a different video. The big thing too that I want to cover here is what they are and what they represent. So here's kind of the meat of the slide, the meat of the video today. So what do stock options represent? One contract equals 100 shares. So let me kind of put that, if you purchase one contract, effectively you have the option to leverage 100 shares per contract of that particular stock or ETF. We're seeing a lot of ETFs actually have stock options or options tied to them as well. So this means that you can leverage a lot of shares for a much smaller cost than buying the shares outright. We talked about the expiration date. We talked about the strike price, the premium. The premium is the price paid for that right or received for the obligation if you sell it. We will go into further strategies again on other videos, but I want to give you kind of an example here. So if one contract is quoted down at the bottom there, an example quote you can see, at $5.65. Now, if we're going to buy, remember we buy at the ask and we sell at the bid. This is from one of the other stock investing videos that I sent out there. So we're going to buy the stock at the ask and we're going to sell at the bid. So if one contract is quoted as $5.65 on the ask to buy it, that's the premium. So in order to buy the one contract, it would actually cost you $565. Because again, remember, it's 100 shares per contract. So if you bought the 100 shares outright, and say the quote on the ask side was $85 for that stock or ETF, then the cost would be $8,500 for 100 shares versus $565. You see the difference there? I mean, we're talking like, $7,000, $8,000 in difference, and you're still having the ability to leverage 100 shares. Now, again, there's also time value that we're going to go into, and we're going to talk about that. We're going to also talk about the premium that you end up paying for it and how that relates to the diminishing value of the option, all in other videos. But again, this is just the basics. So strike price and expiration date, you can see in that sample quote. The example here that I have in here is the SPYs. So that's the Spiders S&P 500 ETF. It tracks the S&P 500. So you can see the strike price on that top quote was $475. That 475.00, that is the strike price. And the expiration date is November 26th of 2021. So this means that on this put contract, it's a put contract because the P is right after that, you have the buyer has the right to sell this contract for $475. I'm sorry, forgive me. The buyer has the right to sell the SPYs at $475 strike price on or before November 26th. Now, below there's the call option quote. So conversely, this call quote gives the buyer of the call the right to buy the SPY ETF at $400 per share on or before December 1st. Now, from a strategy perspective, okay, so we talked a little bit that we're going to get into a little bit of strategy conversation. If the owner of the put contract sees that ETF SPY fall below 475, they may consider either selling the put contract at some value, whatever that value may be on the quote, or they could exercise the option and sell it via exercise option at 475. So if say the Spider ETF is trading at 470 and we own this contract, you've got an intrinsic value of $5 per contract. So $500 $5 per share, $500 total. So we could potentially sell this and get that value from just selling the contract, or we could exercise it and buy it at a lower price. Sell it at a higher price. So the big thing too you got to understand here is that there's always two options. So you can either buy it, sell it, or you can exercise it. So you can trade it from just general, like trading it like a normal vehicle to be traded, or you can exercise. So the big thing here I want you to see is that there's a lot that can be really beneficial about options. So put options have actually even been another strategy. Put options have been considered a form of insurance on a stock. So if you bought a put contract to lock in your gains, another example there is, say you purchased a stock for $50 per share and now it's at 75. So you have a $25 gain on your stock, which is a nice gain. I mean, we're talking, this is like a 50% gain on your original purchase. So you bought it for 50 and now you got 75 on it. So to protect that gain, maybe you buy a put option with a strike price of 70. So you know that you will at least get $20 per share of the profit less any premium paid for that contract. So let me go deeper into that example. So that example there is where you talk about if you're in the stock for 50 and it's now at 75, you got $25. If you buy a contract on a put for 70 as a strike price, say that stock falls back down to 50, you still have the option to sell it at the $70 strike price. So that's where it acts as insurance. There's so many more strategies that we can go into, and I do go into that in the next video. So please, please, please check out other videos on my channel. I hope you found this video on just basics very helpful. Also, please remember to subscribe to my channel, turn on any notifications to learn about strategies in options trading, investing, and any ways to build cash flow. Thank you so much for watching. Cheers to your success. Happy investing.